Two people walk into the same dealership. Same car, same model, same asking price. One buyer gets close to 4% interest, the other gets close to 22. Same car, same day, different number attached to their name. A woman applies for an apartment. The landlord approves her file. Then he asks for first month, last month, and a security deposit. She pays close to $2,000 before sleeping there once. Her neighbor moved in earlier with 1 month up front and a standard deposit. Same building, same landlord, different number. There is a number attached to your name that you cannot see. It is not on your pay stub. It is not inside your bank balance. But leases, loans, cars, phone plans, and insurers can still read it. Every major financial transaction has a hidden price tag attached to it. The apartment has one, the car loan has one, insurance has one, emergency borrowing has one. Those price tags are invisible, but they are real and they collect every month. This is not about wealth, income, or effort. It is about how the system prices you, what this number actually costs, and what changing it actually buys. The financial system does not ignore people with very low credit scores. It has a specific pricing structure for them. Your score is somewhere below 500. It might have gotten there through a medical collection, a repossession, or an eviction, or a period when money stopped working in your favor, or simply a thin file, not enough history for the system to score you accurately. A thin file sometimes reads as a risky file. However you arrived here, the system has already priced you. You apply for a standard credit card. The application comes back declined. You try a store card, also declined. You apply for a secured card. The issuer asks for $200 to $300 of your own money as collateral. You are accessing a credit line equal to your own deposit. You are in effect borrowing against yourself. Apartment applications go differently here. Some landlords decline outright, others approve, but require 2 months up front plus a deposit. You might pay close to $2,000 before sleeping there once in neighborhoods that were not your first choice. Car financing, when it happens at all, comes through lenders who specialize in high-risk profiles. In this example, a lender might quote an APR in the range of 22 to 26%, depending on lender, state, income, and vehicle. On a used car, around $14,000, financed over 5 years, total interest paid could approach or exceed the original price of the car. The exact rate varies by lender, state, and vehicle, but the direction is consistent. You pay substantially more to borrow the same amount. Phone carriers that use credit checks will typically require a deposit or decline a plan entirely. You pay up front for a prepaid arrangement. Some insurers use credit-based scores to set premiums where permitted, raising monthly rates independently of your claim's history. Rules vary by state. Emergency borrowing typically means high-cost options. Payday lenders, cash advance apps, or personal loan products with annualized APRs that can reach several 100%. When rent is short and the options are narrow, the cost of borrowing becomes its own emergency. At this level, the system is not excluding you. It is including you at a premium. Something begins to move, not quickly, but it moves. You have started paying on time, cleared a collection account, and opened a secured card. Progress earns single-digit score increases. The work is real, the feedback is slow, the secured card arrives, you deposited $200, your credit limit is $200. The card carries an annual fee, sometimes $40, sometimes $75, and an APR well above 20% if you carry a balance. You take it anyway, because the alternative is standing still. You treat the fee like rent on your credit history. You charge small amounts. You pay the full balance every month. You do this for months without visible reward. A second card, possibly unsecured, possibly through a credit union, opens at a small limit. 2 open accounts are better than 1. Car loans from traditional lenders come back with rates in the high teens. On a $15,000 loan over 5 years, a lender might quote near 17 or 18% APR. That is substantially lower than the penalty zone rate, but it still means thousands of dollars in interest on a modest car. The cruelest part of this level is not the cost. It is the math of patience. You are doing everything correctly, and the reward arrives slowly. The score moves in increments of 5, 7, sometimes 12 points across months of clean payments. The system rewards patterns, not effort. This is the level where many people stop. The effort feels disproportionate to the progress. It is not. But it takes time to feel that way. You are not through the wall yet, but there is a door now and it is open. The secured card has graduated. The deposit came back. That is the first time the system has returned something to you. Not a celebration, just a direction. Your first unsecured card arrives. The limit is modest. The APR is still elevated, probably in the mid to high 20s. You use it for gas, groceries, paying it off in full each month. You are building history without carrying debt. Mortgage eligibility technically begins here for certain loan products. Some government-backed programs accept lower thresholds than conventional loans. But technically eligible and financially sensible are not the same thing. A lender at this level might quote a rate that generates more in total interest than the original purchase price of a modest home. Whether to proceed, wait, or keep building toward a better rate depends on your full financial picture, your timeline, and market conditions. This is not a decision a credit score alone should make. Car loans from credit unions in this range start to improve. The same car might now carry a rate in the 10 to 14% range, depending on the institution. That is several $1,000s less in total interest compared to level 1. You are not a preferred borrower yet, but you are no longer automatically excluded. The score is working. Not as fast as you want, but every 20 points is worth money. Not as an abstraction, but in actual monthly costs. The system stops treating you as a risk by default. You pass a standard apartment credit check. No double deposit, no extra conditions. You sign a lease like a person with no file attached. That change takes nothing extra to maintain. You just had to get here. Credit limit increases begin arriving. You did not add spending, the bank raised your ceiling, and your utilization dropped. That single mechanical change, more available credit against the same balance, pushes your score forward without requiring new behavior. Your first real rewards card appears. Not a fee card designed to extract value, but a card with cash back or points on spending you are already doing. The reward system starts returning something. Car financing in this range steps down again. In this example, a lender might quote somewhere around 7 to 9% APR, depending on lender, loan term, vehicle, income, and market conditions. The difference between this rate and the rate at level 1 over a 5-year loan on a similar vehicle can represent thousands of dollars in total interest savings. Mortgage rates are still above the best available pricing, and PMI will typically apply until you reach 20% equity. But the monthly payment on the same house is meaningfully lower than at level 2. You are now what most of the financial system considers a passable customer, approved at standard terms without an extra layer of penalty attached to the transaction. The leaks are slowing. Refinancing becomes an option. If you financed a loan at a higher rate months ago, you can now apply for better terms. The interest savings from a rate drop of even 2 to 3 percentage points over the remaining months of a loan add up to real money. Higher credit limits arrive without applications. Your utilization ratio drops naturally as limits expand, and lower utilization improves the score, which opens more limits, which lowers utilization further. The feedback loop starts working in the direction you want. Premium rewards cards enter the picture. Higher bonus categories, larger sign-up offers, better protections. The spending you were already doing now earns more. You can access conventional mortgage loans in most cases, though you may not yet receive the best rate tier. The difference between the rate you receive here and the rate at the next level on the same loan amount can be measured in tens of thousands of dollars over a 30-year term. This level has a specific frustration built into it. You qualify for almost everything. Your record is clean, your payments are consistent. But there is a band of pricing on mortgages, car loans, credit cards, sometimes insurance, where you are approved but not preferred. The gap costs money every month, not for anything you have done wrong, simply for not being in the next tier. That next tier is real, and it is reachable. Something shifts here, quietly, without announcement, the same bank, the same car, the same house, a different price. At this level, you begin receiving the advertised rate, the one in the headline of a lender's webpage, not the rate buried in the footnotes that qualifies a fraction of applicants. That distinction matters every month for years. In this example only, on a $300,000 30-year mortgage, the difference between a penalty zone rate and a rate at this level might mean $150 to $200 less per month, depending on prevailing rates and lender criteria. Over 30 years, the accumulated difference in total interest can reach into 6 figures. These are illustrative figures. Actual savings depend on loan size, term, rates, and lender pricing. But the directional principle holds. Car financing in this range, in this example, might be quoted in the 4 to 6% APR range, depending on lender, vehicle, and market. That is a substantial reduction from the high-risk rates at the bottom of the range. Some insurers that use credit-based scores will reprice your premium at renewal without you asking, where state rules permit and where they apply this model. The penalty structure that followed you from level 1, extra deposits, elevated APR, double conditions, begins to disappear, not because you are wealthier, because the number changed. You stop applying for things. Things start arriving. Pre-approval offers for premium cards with meaningful sign-up bonuses and rewards that return value on everyday spending. The issuers are competing for your profile. At this level, you walk into a dealership with a pre-approval from your credit union. You are not negotiating from a position of need. You are presenting a competing offer. The dealer is aware that you can walk. That changes the conversation. Your mortgage pre-approval opens at rates near the top tier. Depending on lender, loan size, and market, you may be quoted rates close to the best available pricing. PMI, which had been present at every level below this one, is now either gone or avoidable with a standard down payment. Premium cards that were previously aspirational are now accessible with travel credits, lounge access, purchase protections, and annual fee structures that net positive value if you use them. Your credit limits are high enough that routine spending keeps your utilization ratio in single digits. That feeds the score feeds the approvals feed the limits. At this level, the system is no longer making decisions for you. You are making decisions for the system. The system has run out of ways to charge you more. Every category on your credit report reads as clean. No late marks, no collections, no elevated utilization. The friction is gone. The penalties that existed at every previous level, the deposits, the premium rates, the elevated APR, the double conditions, have nothing left to attach to. Lenders sometimes offer proactive rate reductions without a refinance application. Your existing relationships may be repriced because retaining you is worth the adjustment. Negotiation changes character at this level. When you enter any transaction, a car purchase, a lease, a credit line, your pre-approval at a favorable rate creates a position. You are not asking for terms. You are presenting a floor the other party has to beat. Some do. That is additional savings on transactions you were already making. Unsecured personal lines of credit, open at low rates without applications. Home equity access becomes straightforward. Business credit, if you pursue it, is easier to establish. The path from a secured card with a $200 limit to an instant approval on a premium card is not a story about becoming a different person. It is a story about changing a pattern. The financial system does not care who you are. It cares what your file says. The file is built one transaction at a time, slowly, consistently across years. What the system does not understand about you, it does not know whether the original damage came from a medical bill, a period of instability, or a single year that undid several that had been fine. It does not need to know that. It only tracks patterns. That is cold, but patterns are within reach. Your credit score does not measure your intelligence, your effort, or your worth as a person. It does not know your story. It cannot read the context behind a missed payment. It cannot distinguish between someone who spent carelessly and someone who survived a crisis. It tracks one thing, repayment patterns, and it uses that signal to set prices across an enormous range of life decisions. That system is not fair, but you are not trying to reform it. You are trying to use it. And the most important thing about patterns is that they are changeable. The goal is not the score. The goal is what the score produces. Lower monthly costs, less financial friction, more options for your future self. Every level up is not a status upgrade. It is a reduction in what money costs you, the interest you stop paying, the deposit you no longer have to come up with, the emergency you can handle without triple-digit rates. The climb is slow, the feedback takes time, but every payment that lands on time is building something, even when you cannot see it. The score follows you, so does the work.